$11 billion. That is how much WorldCom's accountants moved from the expense column into the investment column. And for nearly 2 years, nobody who was supposed to catch it did. This is the story of how the second largest telecommunications company in America turned bookkeeping into a weapon, and how one internal auditor with a laptop and a question brought the whole thing down. Pull up a chair. We are doing an autopsy. WorldCom was born out of the long-distance telephone boom of the 1980s. A small Mississippi company called LDDS, Long Distance Discount Services, started buying competitors the way a hungry man clears a buffet table. By the late 1990s, after absorbing MCI in a deal worth roughly $40 billion, WorldCom had become the backbone of the Internet itself. At its peak, the company carried more than half of all Internet traffic in the United States. Its CEO, Bernie Ebbers, was a former basketball coach and hotel owner from Mississippi who wore cowboy boots to board meetings and projected the confidence of a man who had never once been wrong. Wall Street loved him. Investors loved him. The stock climbed. And then the Internet bubble began to deflate, and everything Bernie Ebbers had built started leaking air. Here is the mechanism of what happened next, and it is worth understanding slowly because it is almost elegant in its simplicity. Every company has two kinds of costs. There are operating expenses, the bills you pay just to keep the lights on. Things like phone line rental fees that WorldCom owed to local telephone companies every single month. And there are capital expenditures, investments you make in long-lived assets, things you expect to use for years, like buying a new building or laying new fiber optic cable. Accounting rules treat these two categories completely differently. Operating expenses hit your income statement immediately. They reduce your profit right now, this quarter, this year. Capital expenditures get spread out over many years through a process called depreciation, so they barely dent your quarterly numbers. What WorldCom's chief financial officer, Scott Sullivan, and his team did was take roughly $11 billion in ordinary operating expenses, the monthly line rental fees, the bread and butter cost of running a phone network, and reclassify them as capital expenditures. Line costs that should have reduced profit immediately were quietly shuffled into long-term asset accounts instead. On paper, WorldCom looked dramatically more profitable than it actually was. The quarterly earnings reports kept coming in strong. The stock held up. Analysts kept their buy ratings. And the fraud kept growing, quarter after quarter, because once you start a lie that size you cannot stop. Stopping means explaining the gap, and explaining the gap means prison. The unraveling began not in a courtroom or a regulatory office, but in a small internal audit team led by a woman named Cynthia Cooper. In the spring of 2002, Cooper and her team began quietly digging into WorldCom's capital expenditure accounts after receiving a vague tip about unusual accounting entries. They worked at night, after regular business hours, because they did not want Sullivan's team to know what they were looking at. They pulled data on their own time, cross-checked account codes, traced individual journal entries back to their source. What they found did not make sense. There were billions of dollars sitting in capital expenditure accounts with no supporting documentation, no project files, no engineering records, nothing that a real long-term infrastructure investment would have behind it. Cooper brought her findings to the audit committee of WorldCom's board of directors in June of 2002. On June 25, 2002, WorldCom announced that it was restating its financial results by approximately $3.8 billion. That was the first number. The final restatement, after investigators dug deeper, reached approximately $11 billion, making it the largest accounting fraud in American history at the time, a record that would stand until Enron's full tally was calculated, and even then the two competed grimly for the title. The market reaction was immediate and total. WorldCom stock, which had traded above $60 per share at its peak, collapsed to pennies. The company filed for bankruptcy protection on July 21, 2002, with roughly $107 billion in assets, the largest bankruptcy filing in United States history at that point. Approximately 17,000 employees lost their jobs. Pension funds, retirement accounts, and ordinary investors who had trusted the quarterly reports lost billions of dollars they will never recover. Scott Sullivan, the CFO who had engineered the journal entries, pleaded guilty to securities fraud, conspiracy, and filing false statements with the SEC. He cooperated with prosecutors and received a 5-year prison sentence. Bernie Ebbers went to trial. His defense was essentially that he was a big-picture man, a deal maker, a visionary, and that the accounting was Sullivan's department and he simply did not know. Prosecutors argued that Ebbers had pressured his subordinates relentlessly to meet Wall Street earnings targets, and that he was fully aware of how those targets were being met. The jury believed the prosecutors. On March 15, 2005, Bernie Ebbers was convicted on all counts: 1 count of conspiracy, 1 count of securities fraud, and 7 counts of filing false reports with regulators. He was sentenced to 25 years in federal prison. He was 63 years old. He would have been 88 when the sentence ended. In December of 2019, Ebbers was released on compassionate grounds because he was suffering from a progressive brain disorder and was said to be in rapidly declining health. He died on February 2, 2020, at the age of 78, at home in Mississippi. Cynthia Cooper, the internal auditor who cracked the fraud while working late nights to avoid detection, was named one of Time magazine's Persons of the Year in 2002, alongside Enron whistleblower Sharon Watkins and FBI whistleblower Colin Rowley. She later wrote a book about the investigation. She did not get rich from finding the fraud. She got threats, sleepless nights, and a magazine cover. The company itself was restructured and eventually emerged from bankruptcy under the name MCI, which was later acquired by Verizon in 2006. The WorldCom name disappeared. The lesson that this autopsy leaves on the table is not complicated, but it is worth saying plainly. $11 billion did not vanish because of a glitch or a market crash or bad luck. It vanished because a group of intelligent, credentialed people decided that the real numbers were unacceptable and the fake numbers were survivable. They were wrong on both counts. The fake numbers were only survivable until one person in a quiet office late at night decided to actually check. Every financial fraud of this scale depends on the same assumption, that nobody will look closely enough, for long enough, with enough patience to follow a journal entry all the way back to its source. Cynthia Cooper looked. The numbers did not lie to her. The people entering them did. And that is almost always how money dies at this scale. Not with a market crash, not with bad luck, not with forces beyond anyone's control. It dies because someone in a position of trust decided that the rules applied to everyone else.